Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's get back to Disney. I'm told the market can't make up its mind. I'm interested to see what the experts think. We got Paul. Let's get Geetha. Geetha Ranganathan, Bloomberg Intelligence senior analyst on U.S. media. All right, Geetha, what was your biggest takeaway here from Disney?
Really solid quarter for them, Alix, and this is a really strong start for them for fiscal 2025. So, the big numbers, of course, that we constantly look for when Disney reports is how did it do on the streaming subscriber front? And we did expect them to lose a good amount of subscribers, just kind of given the price increases that went in effect late last year, almost 15 to 25% price increases. But churn was very, very limited. So came in much better than they had expected, than we had expected. And then again, the parks numbers. Now, remember, we have been seeing some demand moderation at the parks, but they actually, again, held up better than expected. So all of those, you put all of that together, including streaming profits, you had over a 40% increase in adjusted EPS. So financially, I think the company is off on a solid footing and off to a very good start for 2025.
What could be a less than positive view of this quarter here? Because I'm seeing the stock kind of all over the place. Geetha, it seems like maybe the market can't really decide. So what are some of the concerns out there maybe from this quarter?
I think what was slightly disappointing, Paul, is that they didn't raise guidance. So, they did deliver 40% increase in EPS, but they're still talking about full year EPS only growing in the high single digits. I think that's where maybe the market is slightly disappointed. Again, with the parks also, they didn't necessarily raise guidance. And remember, with the parks, there is a little bit of concern about what competition can potentially do when a new theme park from Comcast, NBC, Epic Universe opens this May. And there's still really conflicting views about this, although management seems to think that it's kind of this rising tide that lifts all boats. So they've downplayed it, but I think there is still some concern about that. And then the other big thing that everyone's kind of looking at or waiting for is the launch of what they call flagship ESPN, which is the first time that ESPN, the full-blown product, will be available without a pay TV subscription. So that's going to happen sometime in the fall of this year. And so again, there are going to be some launch costs where that product prices, what the subscriber outlook will be. So a little bit of uncertainty there as well, but overall, really, really strong results.
And the streaming operation and film studio looking at like a 31% gain in operating income for the quarter. Was that really driven by price hikes for streaming?
For streaming, yes, a lot of it was driven by, we saw really solid ARPU growth. What we're going to continue to see, Alix, through the rest of the quarters is exactly what Netflix did. Disney's kind of taking a page out of that Netflix playbook with what they call page sharing or cracking down on password sharing. And so we're going to see that kind of really ramp up in terms of the streaming profitability numbers. And then you pointed to, content. The box office has absolutely had a marvelous run, kind of reversing so many of, the misfires that we had in earlier years. And they're going to continue to build on that. And as some of those movies come on to the streaming platform, again, they expect that to drive subscriber growth as well.
So, Geetha, what's the market thinking about profitability for streaming at Disney? You look at the Netflix margins, and is there a belief that Disney can at least approach the Netflix profitability?
Absolutely. I think so. I don't think it's going to be immediate, though, Paul. I mean, so for this year, they are guiding to about $1 billion in profit. They did say that they will get to double-digit margins in fiscal 2026. Now, remember, Netflix is already close to 30% margins. So, you still do have that big delta, 10% versus 30%. But I think that's where all of the upside really is with Disney. I mean, this is a complex story with many, many different moving parts. But streaming is obviously one of the, huge positive catalysts. And I think we're going to see that streaming profitability continue to build, especially as they have a lot of pricing power and all of these other different initiatives. And remember, for them, as opposed to Netflix, one area where Disney is better than Netflix is advertising. They've got all of those different, all of the plumbing is in place. They are the biggest digital advertiser right now out there in the market. They make even more in connected TV advertising than YouTube does. So, they obviously have an advantage, a first mover advantage, I would say, with respect to advertising.
Okay, so you mentioned how that flagship ESPN area will do. What's your biggest question now going forward?
Yeah, so it's really going to be how exactly. So again, with ESPN, we have a little bit of questions in terms of where exactly the subscribers will trend for that product. A lot of it, I think, will depend on where the product prices. So that's a little bit of a wait and watch story. And then with parks, yes, we do have confidence that they do have a lot of positive levers. We know that the international parks are performing extremely well. Cruise lines is something that they're really expanding into, and if you just kind of look at the cruise line trajectory, I mean, this was a $2 billion revenue business in 2024. We think this will potentially get to about $10 billion by 2030. And at that point, Paul, we think it could make well over $3-4 billion in EBITDA, which means it's bigger than ESPN at that point. So, cruises is going to be a big portion of their park story. So I think the diversification, story is playing out really well for them with parks. But again, there's a little bit of wait and watch. I think 2025 is still a little bit of a transition year for them.
All right, Geetha, let's back up. I think there's a fair level of confidence in the Disney story. How about some of the other companies? I think about Warner Brothers Discovery. I think about Paramount. What do companies like that do in this world? How do you think that plays out?
Yes, I think for Warner Brothers Discovery, Paul, I think there is still going to be a lot of focus on how the TV business is going to perform. Ironically, I think this year TV is actually in good shape. I mean, why I say ironically is because they actually lost the rights to the NBA. And so everybody was kind of very, very fearful of how exactly, EBITDA was going to be, how affiliate revenue was going to be for this year. But they actually got two huge deals in place, one with Comcast, the other one with Charter, which basically kept their affiliate fees flat. So the revenue trajectory looks decent, I would say, for Warner Brothers Discovery. I think the problem really for them is going out, into the future, and what they decide to do. Is consolidation going to be a big thing? It could be a big thing for them. I mean, we already know that Comcast has kind of spun out its cable networks. We don't know if Warner Brothers is kind of going to follow suit and, maybe do some kind of transaction with Comcast. So that's a little bit of a wait and watch. And again, with Paramount, we're kind of in limbo here because we really don't know what Skydance is going to do in terms of strategy for the new company. I mean, they're already facing some regulatory hurdles, but assuming the transaction goes through, we really have to kind of wait and see exactly what Skydance wants to do with the assets again, whether they're going to let go of some of those linear TV assets, what their real thrust is going to be.
Great stuff. Thank you so much, Geetha. Really appreciate it. Best analysis along with Paul on the street. The two of you cannot get any better than that. Geetha Ranganathan, a Bloomberg Intelligence Senior U.S. Media Analyst.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
This is Bloomberg Intelligence Radio. We're broadcasting to you live from our interactive broker studio right here in Midtown Manhattan. You can also check us out on YouTube.com. I should point out, my daughter still loved Moana 2, and Moana had a sister in Moana 2. So cute. So that worked.
Did you miss Tom singing the Moana song this morning?
I did. That's sad for me.
Oh, good for you.
That's a shame.
That's all right, because I was also
used to
singing.
like that song.
I was also singing one of the Little Mermaid songs in break, so we can all have a Disney sing fest. All right, back to the markets and the question marks. The question marks right now coming very much from D.C. Want to get more intake right now with Henrietta Treyz, managing partner and director of economic policy at Veda Partners. She joins us from Louisiana. Henrietta, last time we talked, you said you're going to be looking for signals from what happens to Trump's cabinet nominees. Who protests? Who doesn't? Do they sail through? To me, everyone's sailing through. So what does that tell you?
Yeah, absolutely. It tells me quite a few things, actually, which is really helpful and constructive. Number one, the Senate Majority Leader, John Thune, does not want to hear Trump reiterate his calls for recess appointments, which takes quite a bit of power away from the United States Senate to advise and consent, which they take very seriously. So they're picking and choosing their battles. And why is that? Because we have a massive legislative agenda heading their way, and they want to be able to override the House Republican leadership. So this comes into play with the 1 or 2 reconciliation bill strategy. And as of this afternoon, Senate Budget Committee Chairman Lindsey Graham is going to start exerting his power to run over the better legislative agenda intuitions of the House Republican leadership. So this, to me, signals that the Senate's trying to keep Trump happy, knowing that they're about to run roughshod over the House, which is very normal, and that they also want to avoid the idea of recess appointments. So really constructive guidance coming from just their actions here.
All right. From the White House, Henrietta, tariffs on, tariffs off, tariffs delayed. What's the sense in Washington, D.C. about what the strategy is maybe of President Trump and his administration?
I think a lot of members are sort of not even bothering to pretend that they know strategy, but are instead giving us also really important context clues about what they're expecting to factor in from tariff revenue on the next tax bill or the next immigration, military spending, energy package. They are factoring in some level of revenue from tariffs, and the estimates are anywhere between $700 billion and $1 trillion. So it's not really a question of how the president goes about landing on putting tariffs in place. There's obviously been fits and starts, 30-day delays with Canada, Mexico. Maybe there will be a phone call with President Xi in China, but they're really more giving us the valuable guidance that they are going to be seeing tariffs in their revenue scores, which means that they expect tariffs to go on however the president decides to impose them. So again, instructive just in their directionality of incorporating tariff revenue into their forecasts.
Yeah, I thought we were going to get that Xi-Trump call yesterday. So I don't know. We'll keep waiting for that one. So actually, let's combine these 2 points then, because if we do expect to see some form of tariffs because of that revenue estimate that you talked about, and we do see no one wanting to torpedo the Trump agenda on the Republican side, does this mean that the tax bill has a significant chance of getting through and getting through quickly?
No, definitely not. What's happening instead is the Senate is about to. It's exactly the opposite of that. I think the House Republican Conference is effectively nowhere on a budget. They have a very fractured conference and only one seat to spare in terms of votes. So they don't have a path forward on one big bill, or maybe even two. However, what the Senate is doing is they're trying to give President Trump a legislative win, especially going into his joint address to Congress on March 4th. They have an ambitious timeline where they're going to try to get budget reconciliation instructions done in February and early March, tee up actually writing the bill in April. But this would be on the smaller immigration and military spend package. The tax bill, in my opinion, has been consistent. It's not going to pass until December. We're talking about $5 trillion worth of negotiations. That takes months, indeed almost a full year. And they've known that this is coming since 2017 when the tax bill passed. So we still have a lot of work to do. And in the intervening months, we have to deal with a government shutdown on March 14th, a debt ceiling negotiation over the summer, another prospective government shutdown September 30th. There's a lot of opportunities for Democrats to throw wrenches in the gears of the Republican legislative agenda. And to me, that points a pretty clear experienced picture that the tax bill won't happen until December.
Henrietta, I guess it should be no surprise to observers that President Trump sucks most of the air out of the room most of the time. Are you surprised that you don't hear more leadership from either congressional Republicans or Democrats?
I think that they have been out of session, to be fair. And now that they are back in session, they have to deal with things like, hey, are we going to occupy Gaza? What's going on with Doge? What's going on with potentially the Doge team being able to access Treasury payment systems? There's so much out there that they're really just flying with it and negotiating behind the scenes on those legislative agenda items, especially on the Republican side. I think Democrats have not found their footing at all. I do see some opportunity for them to coalesce behind that March 14th deadline for a government funding bill. If they can come together with the appropriators and leadership and say, we want 1% more in federal spending in 25, we want aid to the California wildfires, et cetera, they can get in a cohesive place. But right now, they're just letting Trump have the show.
So what is up with Doge?
What's up with Doge? That's a great question. I think that is the question. Right now, they've implemented a number of freezes, and that is something that's obviously creating a lot of lawsuits, and 2 judges have stayed those actions. They are going through and combing through the Treasury payment systems. There's reports that Elon Musk has been at the VA going through some of those payment systems potentially. And the question is really, have they identified via their AI tech savvy, any duplicitous payments, any payments that are going to people who are no longer with us. Is there any kind of abnormalities? Those are the areas where they're trying to find savings. And then obviously you have that idea of cutting the overall federal employee base. But all told, those are really small dollar amounts, less than 1% of federal spending. And by the things that I just listed a moment ago, aid to the wildfires, aid to farmers as we prepare for the trade wars, continued spending on the tax side, and 1% increases in 2025 spending, $300 billion in military spending. Whatever DOGE is able to find, Congress has already spent. So I'm not seeing a lot in terms of functional deficit reduction or spending cuts that will offset what Congress will do.
Okay, Henrietta, thank you so much for that great synopsis there. A lot of moving parts down there in Washington, D.C. In Congress with all those bills that Henrietta was laying out for us. Henrietta Treyz, Managing Partner and Director of Economic Policy for Veda Partners, kind of laying it all out for us.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Interest rates, they impact
Stuff.
real estate business.
Oh, yeah, it does.
Commercial real estate business. Lisa Nee joins us, Managing Partner and Head of Real Estate for EisnerAmper, joining us here in our Bloomberg Interactive Brokers studio. Lisa, let's talk about that. I mean, it looks like rates are coming down, but maybe not as fast as people like. How's that impacting just commercial real estate broadly defined? What are you seeing out there with your clients?
What a great segue. Thank you for having me. So it's exactly the perfect way to start talking about this, is that with interest rates being where they are and the unknown of what's going to happen going forward, we're sort of at a standstill in valuation. However, the activity in real estate for 2024 was up, and we do predict 2025 having a lot more trading, people going back and forth and trying to figure out some deal flow, which means that valuations have to come, which is tied to interest rates. It's not going to get back up to where we were in 2017, but I think everyone's really optimistic for 2025 that there is going to be some things happening in there. When we talk about interest rates, and we just heard from Mike McKee where the settling is and what the feds are doing, it's interesting. Once rates are still low for the people who have existing mortgages and things, it's not going to make us able to go out and sell our houses because we still have very low interest rates. And so all of that is going to affect multifamily home buyers. It's going to affect office. It's still going to trickle through the rest of all the sectors of real estate. So yes, you're right. It's a great segue into real estate is where we are on interest rates. And that's the big unknown, and waiting and seeing with the inflation being where it is and the economy doing well. It's a wait and see approach.
Yeah, and just how quickly we've re-rated, really. We're looking at just over 40 basis points of cuts priced into world implied rate probability. Morgan Stanley sees just one cut now in June rather than two in March and June. How quickly does that feed through to prices?
It actually feeds through quicker than it's even announced. It's almost like people know before and anticipate it, so the valuation is already baked into it. And so it feeds in immediately. And so when you think that feds are going to announce it and things are going to move drastically, it's already moved once the anticipation is there and what they think are going to do, what they think is going to happen with those rates.
Let's talk about just office. What are the trends here in office? I guess the first question is anybody going to call a bottom? Has anybody called a bottom? Is anybody thinking about that?
Do you want me to make a prediction
yes,
right here?
Please.
Should we do it?
Yes,
Should we have some fun? Okay, so prediction that I heard was 2026, New York City is going to have a shortage of office available.
Really?
A shortage, because there's been a lot less construction. We do have some conversions, not a lot, but there will be some conversions to residential. The trophy buildings are occupied, which is going to help the A's and B's. And so, we know that tech is going back to work. We've heard those announcements. Today, this place is the busiest it's been, I think, in a long time. And media has made an announcement that they need to start coming back to work. So with everybody making those announcements of back to work, there's been less office coming on the market in the last 2 years or 3 years because of construction costs. And so prediction that New York City, you want another prediction?
Yeah.
Sure.
Don't write off San Francisco yet. And why? I know we're very bleak on that, but 72 cents of every AI dollar is going into San Francisco. And so with all the money going into San Francisco.
Meaning that because people live there, work there?
So 83.2, and I think that's the right statistic. Somebody will write it if it's not. Of the talent is in San Francisco based.
Okay.
And so the VC venture capital firms that are funding the AI are mandating that they want to see the people and they want that in-office experience. And so if 83.2% of our talent is in the San Francisco Bay Area, who are funding and working on the AI, we see where the future is. And so maybe not to write off San Francisco. So a little bit of optimism, I think, in office. We'll see in a year from now how off I was, but we'll be optimistic.
Have we seen any transactions of note in New York City that gives you a sense of where valuations are?
Yeah, there's been a bunch of movement. I think there was a 57th Street. There was a property that just was acquired. And so people are moving, and the values are, strangely enough, they're holding up. And so the whole thing is the buyer and the seller is willing to come up to where they think prices are. And I think yesterday there was a large transaction that just happened on 57th Street, which is noteworthy, I think.
Yeah, definitely. What do you think the bottom looks like?
I'm hoping we passed it.
Okay.
I think we're headed to a really good direction from
so I guess what the trajectory from now until 2026 does look like. Like, is it bumpy? Is it a straight line up? Is it a curve?
So everyone was hoping for a soft landing, and I think we got the soft landing. And so when you're looking for the future of to where, people are seeing where we're at, secondary markets are going to be really, really hot. So is the live, work, play environment. And that type of world. Now, New York is live, work, play, but look at the secondary markets that are going to create that live, work environment for them. And so if you look at, we could go into this another time, the history of the malls, but that's really what was supposed to be created. It wasn't supposed to be a mall with 2 anchors with 70 acres of parking. It was supposed to be houses, hospitals, schooling, businesses created around the malls. That's what people want. And that's what we're going to start creating. And so once we give people that sort of environment, I think it's going to really, really work. And then looking at operational real estate, data centers. Yeah. Right? So there is a lot of optimism out there in real estate as to what we're looking forward. And then just watching interest rates really closely.
I have to admit, I'm still surprised every day I walk out on Lexington Avenue, that retail space has not sold.
No, but they're redoing it. They're doing I wonder if it's now rented because that space, the Gap used to be.
But it still feels like there's so much unrented retail in Midtown Manhattan. It really surprised me.
And Upper West Side, too.
Yeah, but when you look at it, though, there was so much more. And we know that retail was doing horribly, years ago. And it is making that comeback of changing it, what's that retail experience for. I mean, I know that we read the 5 or 4 big boxes that are closing stores. And so that scares everybody a little. But again, it's coming back to that live, work, play and finding that balance of what people want in that area. This is still relatively commercial here and not as residential. So you're not really living where you're working here. And so it'll be interesting to see. And without the, Bloomingdale's is still a very large anchor to this area. So I think it's going to get leased up over time.
I don't want to live where I work. Just putting that out there. Anyway, Lisa, thanks a lot. Always great to get your perspective. You're so fantastic. Lisa Nee, managing partner and head of real estate for EisnerAmper, and she comes with predictions.
Oh boy.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.